Because the market is currently closed on this Sunday, June 2026, we have to look closely at the final numbers from the last active trading session to understand what is truly happening behind the scenes. As of the market close on Thursday, June 18, 2026 at 4 p.m. Eastern Time, NUBURU stock, trading under the ticker symbol BURU on the NYSE American exchange, finished the day at exactly $0.16, registering a decline of 2.08% for the session. The intraday tape showed a high of 17 cents and a low of 15 cents, with a massive trading volume exceeding 25 million shares. Now, the natural immediate reaction to seeing 25 million shares change hands on a microcap company with a market valuation hovering around $29 million is to assume that a massive wave of accumulation or institutional buying is secretly taking place. But if you look beneath the surface of this frantic trading volume, a completely different reality presents itself. This heavy volume does not signify structural accumulation by long-term funds. Instead, it indicates a highly calculated, structured liquidity extraction process driven by ongoing dilutive financing arrangements, where convertible debt holders are consistently converting their notes into common shares and systematically liquidating them directly into retail buying pressure. When traders browse popular investing sites looking for speculative opportunities, the standard expectation surrounding this company centers on its unique technological niche. The common narrative is that this firm owns proprietary technology in high-power industrial blue lasers that can outperform traditional infrared systems, placing it in a prime position to secure massive commercial manufacturing contracts. This technical promise attracts a steady stream of retail participants who utilize platforms like the Robinhood app or manage self-investing accounts, hoping to catch an exponential breakout similar to what early tech investors experienced with Nvidia stock. However, the underlying financial reality directly challenges this optimistic thesis. When you inspect the actual capital structure of the company, you find a relentless mechanism of stock issuance that continuously increases the outstanding share count. This means that even if the technical milestones are met, each individual share represents a rapidly shrinking slice of the overall corporate pie. The market narrative promises a major breakthrough in specialized welding sectors, but the raw financial data shows a company working through severe cash burn, reliant on continuous stock dilution just to sustain daily operations. To properly analyze the recent price action, one must look at the immense structural volatility that has defined the trading behavior of this ticker over the past few weeks. Moving through early June, the price has been confined to a brutal penny stock band, swinging violently between 14 cents and 19 cents on an almost daily basis. For everyday individuals using a standard individual brokerage account, these multi-percentage swings look like excellent opportunities for quick intraday trading profits. But when you compare this level of instability to standard large-cap assets like Tesla stock or Apple stock, the structural differences are staggering. While mega-cap technology firms rely on robust institutional order flows, share buybacks, and deep options market liquidity to anchor their valuations, a microcap stock like this operates almost entirely at the mercy of short-term retail momentum and automated algorithmic market makers. Those who choose to invest online without institutional tools are often caught completely off guard by the speed at which these microcap shares can drop, failing to realize that the massive 25 million share volume days are frequently artificially inflated by high-frequency market makers scraping fractions of a penny rather than actual buyers building permanent positions. The pressure on this stock is further compounded by the fundamental shift in macroeconomic conditions affecting the broader markets throughout 2026. In an environment where capital is no longer cheap, early-stage industrial technology firms face an uphill battle to secure non-dilutive financing. When retail traders look for investment help or use automated allocation tools like Schwab Intelligent Portfolios or a generalized intelligent portfolio, they are usually guided toward diversified exchange-traded funds or stable blue-chip balances. Speculative single-ticker bets on penny stocks are heavily exposed to shifting credit markets. If you look at the balance sheets filed over the recent quarters, the firm has consistently struggled to generate meaningful commercial revenue while keeping up with heavy operational expenses, creating a situation where they most repeatedly tap equity lines of credit. This dynamic is exactly why retail buying interest on a popular online investment platform rarely results in sustained upward price movement. The market is constantly being flooded with new supply, neutralizing any genuine bullish momentum generated by retail communities. Let us evaluate the core industrial focus of the business model to understand what the company actually builds. Founded as a pioneer in blue laser technology, the firm designs and manufactures high-brightness, high-power systems such as the AO150 and the specialized NUBURU BL series. The fundamental premise of their business is rooted in material science, specifically how different metals absorb light. Standard industrial manufacturing relies on infrared lasers, which work reasonably well for steel, but are highly inefficient when dealing with yellow and red metals like copper, aluminum, and gold, because these materials reflect the vast majority of infrared light. Blue light, conversely, is absorbed by copper at a rate that is several times higher than infrared light, allowing for faster, cleaner, and more precise welds without the structural defects commonly caused by older laser systems. This specific advantage makes their hardware highly relevant for electric vehicle battery production, aerospace components, and advanced additive manufacturing setups.
Yet, despite having a clearly defined technical advantage, translating this intellectual property into consistent commercial cash flow has proven incredibly difficult, as industrial supply chains are notoriously slow to adopt completely new hardware architectures. Comment below how many shares of NUBURU you currently hold, or if you prefer sticking to large cap tech instead. Looking at the order book mechanics across platforms like the Interactive Brokers platform or through active Robinhood stock trading channels reveals that the vast majority of participants are treating this name as a short-term trading vehicle rather than a core long-term holdings asset. When managing an active strategy via a SoFi investing account or utilizing specialized automated tools, tracking the exact timing of institutional filings becomes far more important than analyzing the underlying physics of the laser systems. Active traders on the SoFi trading platform try to time the technical bounces when the stock hits its historical support floor near 14 cents, but this strategy carries an immense risk of capital impairment if the company is forced to execute a reverse stock split to satisfy exchange listing requirements. The NYSE American exchange maintains strict rules regarding minimum share prices, and trading persistently below 20 cents puts the company in a precarious position where structural corporate changes become mandatory rather than optional. When we look at the future outlook and map out the tension between investor expectations and market realities, several distinct paths come into focus. The optimistic scenario relies on the company successfully scaling its recent defense contracts or securing a major commercial partnership with a top-tier automotive manufacturer looking to optimize its battery assembly lines. If such an event occurs, the immediate revenue injection could temporarily halt the need for dilutive financing, causing a massive short squeeze that would show up instantly across online investing tracking systems. On the other hand, the more realistic scenario based on historical financial performance points to continued friction. The upcoming earnings release, scheduled for July 30 pre-market, will provide critical clarity on whether the firm is managing to reduce its steep net losses or if the cash burn rate is accelerating. For investors evaluating options through Fidelity investments, managing retirement accounts via Fidelity IRAs, or analyzing trends on the Fidelity trading platform, the decision to allocate capital to an unproven microcap requires weighing these existential operational risks against the low nominal share price. The structural contrast between speculative market narratives and hard financial metrics is precisely what separates experienced investors from market gamblers. While retail communities on social platforms continue to debate the theoretical upside of advanced blue laser applications, institutional market makers use highly advanced algorithms on the Interactive Brokers desk to systematically capture the spread created by retail volatility. This difference in execution capability means that the casual trader using a basic Fidelity mobile app or casual Robinhood investments features is often operating at a severe informational and structural disadvantage. True clarity in microcap investing comes from acknowledging that a brilliant laboratory product does not automatically translate into a profitable public corporation. The historical price trajectory of this asset, which has steadily eroded from its initial public levels down to its current sub-dollar valuation, stands as a clear reminder of how destructive continuous equity dilution can be to early shareholders. To conclude our analysis, the situation surrounding this specialized laser manufacturer illustrates the classic friction between a compelling technical narrative and an unforgiving corporate financial layout. The expectation held by casual market observers is that the uniquely efficient blue laser technology will eventually break through industrial barriers and reward patient buyers with immense gains. The reality, demonstrated clearly by the closing price of $0.16 on Thursday, June 18, 2026, is that the persistent need for operational capital has structured the stock as a dilution vehicle where heavy trading volume reflects share creation rather than institutional accumulation. While the technical advantages in copper welding remain completely legitimate, the corporate structure itself remains burdened by cash constraints, upcoming earnings scrutiny on July 30, and the constant threat of regulatory listing compliance issues. Navigating a position in this asset requires a complete departure from emotion and a strict focus on order book mechanics, volume tracking, and dilutive filings, rather than purely relying on the long-term promises of the technology. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.